Have you noticed what's happening in the stock market lately? It feels like it's telling two completely different stories at the same time. You've got one story of record highs, just a roaring bull market, and then the other is a story of a pretty serious pullback. It's a split personality market for sure, and in this explainer, we're going to break down what's really going on.
So check this out. On one side of this great divide, you've got the Dow Jones, packed with all those industrial giants, and it's hitting a new all-time high. But on the other side, the tech-heavy NASDAQ is actually falling. And this isn't just a little difference. It is a fundamental split in where the big money is heading.
So the big question is, why? Right? What is happening behind the scenes that's powerful enough to pull the market in two totally opposite directions, rewarding one group of stocks while punishing another? Let's dig in and find out.
Okay, our first stop on this journey has to be the Federal Reserve. Its recent moves have been a huge catalyst, and it's really what created the first half of this story, the big surge we're seeing in those stable, established companies.
So what the Fed did was cut interest rates by 1/4 point. Now, that one move sent this powerful signal to investors. It basically caused a wave of cash to rush into what's seen as the safety of blue-chip stocks. Think Visa, Home Depot, and that directly fueled the Dow's record-breaking climb.
And yeah, that rate cut definitely helped calm everyone's nerves. You saw the VIX, which is basically Wall Street's fear index, take a nice little dive. But, and this is the really crucial part, the Fed also made it super clear that this isn't the start of some kind of free-for-all. They signaled maybe only one more cut next year, and that put the brakes on a big speculative rally and is forcing investors to be way more selective.
Okay, so that's one half of the story. But while the blue chips were celebrating, the tech world, and especially the AI sector, was getting a serious reality check. You could say the era of pure hype is finally crashing into the hard numbers on the balance sheet.
This quote just nails the shift in thinking perfectly. See, after some pretty disappointing earnings from tech giants like Oracle, investors are kind of done just buying the story of AI's potential. Now they're demanding proof. They want to see a real, profitable return on all the billions being spent.
And wow, the fallout was immediate. Key players right in the middle of the AI universe, like chipmakers NVIDIA and Micron, they took an instant hit. This wasn't a broad market panic. It was more like a surgical strike on companies at the very heart of the AI boom, all driven by this new demand for actual profits.
And if you want to understand just how much speculation was baked in, just look at Micron. It was rated as having no economic moat. That's that durable competitive advantage that protects a company, kind of like a castle's moat. And yet, it was trading at a massive 60% premium. So when the mood changed, these were the first bubbles to pop.
So with a market this divided, how in the world are you supposed to navigate it? Well, it turns out there's a specific strategy that's almost tailor-made for this exact environment. A smarter way to find growth without just paying for hype.
It's called GARP, or stands for Growth at a Reasonable Price. And the idea is really as simple as it sounds, but it's so powerful. You find fantastic companies with great growth potential, but you refuse to overpay for them. It's the perfect mix of a growth mindset and value discipline.
Now, applying this isn't just guesswork. It's a super rigorous 3-step process. First, you do a quality check. The company has to have a strong, defensible business. Second, you check the price. Using a metric called the PGY ratio, which balances price against growth and dividends, you make sure you're not paying too much. And third, you check for efficiency. A high return on equity shows the company is brilliant at turning its capital into profits.
Okay, so that's the theory. But what does this actually look like in the real world? Let's take a look at 5 companies that managed to pass this really tough GARP screen and seem pretty well positioned for the market we're in today.
And here they are. Now, this isn't just a random shopping list. It's structured like a diversified portfolio designed to balance out risk and reward. You've got a quality anchor in JP Morgan, diversified tech growth with Qualcomm, an AI value play in IBM, a high-octane growth shot with PDD, and then this really unique income plus growth story with AbbVie. And just look at those strong metrics across the board.
So we'll start with JP Morgan, which is basically the bedrock of this whole portfolio. As one of the most dominant banks in the world, its massive scale and its, fortress-like balance sheet are really designed to provide stability and income, grounding the portfolio no matter which way the market winds decide to blow.
Next up is Qualcomm, and if you still think of them as just a smartphone chip company, you really need to look again. They have made this incredible pivot into high-growth areas like automotive and the Internet of Things, all while keeping up an amazing track record of 23 straight years of dividend growth.
Now, for the high-growth part of the portfolio, we've got the Chinese e-commerce giant PDD.
Right now, it's trading at a whopping 50% discount to what some believe its fair value is. Now, yeah, there are risks tied to its market, for sure, but that massive margin of safety is the key reason it's included. It offers a potentially huge reward.
And finally, we have the really unique case of AbbVie. It's almost like two investments in one. On one side of the coin, you have rock-solid safety, with 54 consecutive years of dividend growth. But then you flip it over, and you see this just explosive growth forecast, driven by its drug pipeline, which leads to a projected return on equity of nearly 400%. It is that rare company that gives you both defense and offense.
Okay, so we've looked at the problem and a potential solution. What is the big picture takeaway here? How do you navigate this really tricky market inflection point? You know, the core message here is just discipline. The days where a rising tide lifts all boats, those seem to be on pause, at least for now. Success is going to require being highly selective. It means focusing on companies with those deep economic moats we talked about, demanding proof that they use their cash efficiently, and balancing that hunt for growth with a need for stable, resilient income.
And that brings us to one final question to think about. We're watching a major shift happen, away from hype and toward a demand for real results. So, as this trend continues, could it be that consistent, durable, and even boring profitability actually becomes the most exciting growth story of all?